Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So it is August 15th, 2026, and, in this current Trump administration economy, the market's just moving incredibly fast.
Oh, absolutely. They really are.
Yeah, we are seeing all these policy shifts. Capital is just flying across borders, and investors are they're reacting to global news at a super rapid clip. But through the entire history of the modern American stock market, there has basically been this one constant, right? A closing bell.
Right, yeah, the 4 p.m. bell.
Exactly. A very specific time when the dust settles, the screens stop flashing, the servers kind of wind down, and the market just goes to sleep. But what if the stock market never went to sleep at all?
Well, based on recent analysis, we're actually moving way past hypotheticals on this. I mean, the whole concept of a market that sleeps it's about to become totally obsolete.
And that is exactly the core mission of our deep dive today. We are looking at this massive structural shift that is targeted for December 6th, 2026. So the U.S. stock market, and this is specifically driven by a sweeping proposal from Nasdaq, is preparing to move to a 23-hour-a-day, 5-day-a-week trading schedule.
A 235 schedule, yeah.
It's huge.
It is. So we are going to break down exactly how this quote-unquote sleepless market will function and why, a stock price at 3 a.m. behaves fundamentally differently than a stock price at 3 p.m. And most importantly, what this continuous loop means for your everyday investing strategy.
Right, because to really understand how this impacts, an individual portfolio, we first have to look at the actual mechanic of this new market clock. This is a complete reimagining of financial time.
Okay, so walk us through it. What does the new clock look like?
Well, according to the proposals, we're looking at a brand new night session, and this is going to run from 9 p.m. to 4 a.m. Eastern Time.
So this essentially acts as a bridge, right? It seamlessly connects to the existing extended and regular sessions, which those already run from 4 a.m. all the way through to 8 p.m.
Wait, hold on. If you map those hours out, there's a very deliberate gap there.
Yep, good catch.
Right, because the market runs until 8 p.m., but the night session doesn't kick off until 9 p.m. So what exactly happens in that one missing hour?
So that 60-minute window is essentially a mandatory industry-wide breather. Every single day, from 8 p.m. to 9 p.m. Eastern Time, trading just halts entirely.
Oh, wow. Just a hard stop.
Exactly. It's required for deep system processing. They have to transition the official trade date to the next calendar day and really just reset this massive technological machinery that underpins the whole global stock market.
It kind of sounds like a 24-hour diner closing the kitchen for 1 hour just to, scrub the grills, run the cash registers, and switch the menus before the overnight staff clocks in.
That's actually a perfect analogy. And just like a major franchise diner, this operation covers practically everything. This schedule doesn't just apply to heavily traded mega cap tech stocks, like your NVIDIA, Apple, or Amazon.
Right, the big guys?
Yeah, but market data shows this applies to all NMS stocks, that's the national market system, as well as exchange-traded products on the Nasdaq.
Wow.
Yeah, so we are talking about thousands of individual companies and funds operating on this continuous loop.
Okay, I have to challenge the practicality of this, though. You make it sound like Nasdaq is just, leaving the servers running and keeping the lights on for a few insomniacs. Running a market for thousands of securities isn't free.
Definitely not.
Right. So who is actually demanding this, and who's paying to overhaul the system?
Well, the demand is largely geographical, actually, and the costs of the overhaul is tied to the physical, quote-unquote, plumbing of Wall Street.
Okay, unpack that for us.
Sure. So flipping a switch to enable 24-hour trading is what you see on your smartphone brokerage app, right? But behind the scenes, making this happen requires a monumental overhaul of two incredibly complex systems, the SIP and the DTCC.
Okay, let's translate those acronyms for everyone because they really are the invisible engines of the market. So the SIP, the Securities Information Processor, is essentially the giant unified digital scoreboard, right?
Exactly. Consolidates all the trades from all the different exchanges.
Right, and it ensures that every investor, whether you're sitting in New York or Tokyo, sees the exact same official price for a stock at the exact same millisecond.
Spot on. It is literally the central nervous system of pricing data. If the SIP goes down, true price discovery just stops.
Oh, wow.
Yeah, and operating that system securely for 23 hours a day without that traditional overnight maintenance window we used to have, that requires massive redundancy and entirely new fiber optic infrastructure.
And then you have the DTCC, right, the Depository Trust and Clearing Corporation?
Right, the actual plumbing.
Yeah. Like when you hit buy on your app, the DTCC is the entity that actually ensures your money leaves your bank, the seller receives that money, and the digital share of the stock is officially registered in your name.
Exactly. And traditionally, clearinghouses like the DTCC, they rely heavily on those overnight hours to settle millions of trades in these massive batches.
Right, when the market is asleep.
Exactly. So moving to a 235 model means they have to shift much closer to continuous real-time settlement while the market is still live.
Wow, so they're basically rebuilding the airplane while it's flying.
Basically, yeah.
If it is that technically demanding, the capital pushing for this must just be absolutely enormous.
Oh, it is. And it originates primarily from overseas. Recent industry reports highlight a massive push from Asian investors, actually. Just consider the time zone overlap.
Right, okay.
9 p.m. to 4 a.m. on the U.S. East Coast is right in the middle of the normal business day in huge financial hubs like Tokyo, Seoul, Shanghai, and Hong Kong.
Ah, that makes total sense. So previously, an institutional investor in Tokyo who wanted to, say, build a position in U.S. software companies, they had to staff a trading desk in the middle of the Japanese night.
Right. Or they'd have to route their orders through these complex, expensive intermediaries.
Mm.
And Asian investors have this massive growing appetite for U.S. equities. By shifting the operating hours, the U.S. stock market transforms into this ultimate global financial platform.
It just opens the floodgates.
Exactly. It allows foreign capital to flow directly into American companies during normal Asian business hours. It really solidifies U.S. markets as the primary wealth generation engine for the globe.
Okay, so if we have this massive influx of global capital and the infrastructure is running around the clock, it is super easy for an everyday person to assume that buying a stock at 2 a.m. will feel exactly the same as buying it at 2 p.m.
Yeah, that's a very common assumption.
But if the market is highly illiquid, that assumption is incredibly dangerous, right?
Mhm.
We really have to separate the idea of a market being open from a market being useful.
That is the crucial distinction. That difference will dictate who survives this transition and who just loses their capital.
Let's frame this with a real-world scenario so it's super clear. Imagine you want to sell a highly valuable, rare baseball card, right? And you take it to a massive flea market. If you show up at 2 p.m. on a Saturday, the aisles are packed.
Right. Tons of people.
Exactly. You have hundreds of collectors, dealers, casual buyers walking around. You can show the card to 10 different people, get multiple competing offers, and drive the price up to its true fair market value.
Right. And in finance, that high foot traffic creates what we call deep market participation and tight liquidity. Buyers and sellers are aggressively competing against each other.
But imagine taking that exact same rare baseball card to the exact same flea market at 3 a.m.
Oh, yeah. Totally different story.
Right. The gates are technically open, but almost all the stalls are boarded up. There is only one tired vendor sitting in the back corner drinking coffee. If you absolutely must sell the card right then, you have zero leverage. That single vendor has no competition, so they are going to severely lowball you.
And that vendor, in the financial world, is a market maker protecting their own risk. The data completely validates that scenario, by the way.
Really?
Yeah, projections from the DTCC and Ernst & Young indicate that even as this whole system matures by 2028, these extended night hours will likely only capture somewhere between 1% to 10% of total U.S. equity trading volume.
Wow. Only 1 to 10%.
Yeah. The overwhelming majority of capital exchange is still going to happen during those traditional daytime hours.
Which means the 3 a.m. market, despite all that Asian capital coming in, is largely empty relative to the afternoon.
Exactly. It creates this fragile environment of what we call thin liquidity. And thin liquidity just violently distorts the bid-ask spread.
Okay, let's break that down. So in a highly liquid 2 p.m. market, market makers are competing so fiercely for your trade that the gap between the highest price a buyer will pay, which is the bid, and the lowest price a seller will accept, the ask, is often squeezed down to a fraction of a single penny. It is incredibly efficient.
Right. But step into the 3 a.m. dead zone where all that volume just evaporates. That single market maker who's actually willing to take the other side of your trade, they take on a lot of significant risk by holding shares when no one else is around.
Because they might not be able to offload them.
Exactly. So to compensate for that risk, they widen the spread drastically. The highest bid might drop down to $100, while the lowest ask jumps up to $105. If you force a trade in that environment, you are instantly losing capital just across that spread.
You are essentially paying a heavy, desperation tax just for the privilege of trading in the dark.
That's a great way to put it. And Nasdaq is acutely aware of how destructive this can be for uninformed participants, which is why the proposal includes specific safety mechanisms. They're effectively putting governors on the engine during the night session.
Okay, so what do those mechanical brakes actually look like?
The most critical protection is a complete ban on standard market orders during the night session.
Okay, and just as a reminder, a market order is an instruction to your broker to execute a trade immediately at whatever the best available current price is.
Right, and at 2 p.m., that guarantees execution at a fair price. But at 3 a.m., if the order book is basically empty and the only available ask price is, say, 30% higher than the last trade, a market order will instantly fill at that terrible price. It just destroys your capital.
Ouch. So participants will be forced to use limit orders instead.
Yes, exclusively limit orders.
Right, where you physically type in the exact maximum price you are willing to pay or the absolute minimum you are willing to sell for. If the market doesn't meet your specific limit, the trade simply doesn't happen.
Exactly. It acts as an automatic circuit breaker for your own portfolio. The second structural break is the implementation of static price bands. They're adapting the existing limit-up-limit-down rules for a thinner market. The proposal outlines capping price movements at around 20% above or below a specific reference price.
Meaning if, an erratic algorithmic trading glitch triggers a massive wave of automated selling at 4 a.m., a stock can't just free fall to zero while human regulators are asleep.
Right. The system physically prevents trades outside that 20% corridor. Those guardrails are essential because an illiquid market is inherently prone to erratic, violent swings.
Which leads us directly into this massive narrative that is really gaining traction online right now. You see a lot of commentary claiming that a 235 market is this ultimate democratizing force.
Oh, I've seen those posts.
Yeah. The pitch is that by keeping the market open all night, retail investors will finally be on a level playing field with Wall Street insiders, effectively stripping away their historic information advantage.
It is a very appealing narrative, I'll give them that. But when you analyze the actual mechanics of institutional trading, that claim just falls apart completely.
So let's dissect the difference between reaction speed and actual information parity. Because if a major geopolitical crisis breaks out, or a supply chain collapses halfway across the world at midnight Eastern time, the old system forced a retail investor to just sit on their hands for 9 agonizing hours.
Right, just sweating it out, waiting for the morning bell while futures markets tanked.
Exactly. But under this new 235 framework, that delay is gone. You can open your phone at 12:05 a.m. and execute a trade.
And that's true. The system undeniably closes the reaction speed gap. You are no longer locked out of the building. But gaining access to the building does not mean you possess the same tools as the institutions who are already inside.
Oh, definitely not.
Wall Street hedge funds and quantitative trading firms, they don't rely on the same news feeds as retail investors. They employ natural language processing algorithms they can ingest, analyze, and trade on a central bank press release in a matter of milliseconds.
Milliseconds? That's crazy.
It is. They utilize proprietary data feeds and literal microwave transmission towers to execute trades faster than a retail investor's app can even load the push notification.
So essentially, we both get access to the golf course at 3 a.m. But I am stumbling around in the dark with a rusty 7-iron and a flashlight, while the multi-billion-dollar hedge fund has military-grade night vision, a team of caddies mapping the wind, and custom-built clubs.
I love that analogy.
Yes. Just because we are on the green at the same time does not mean I am suddenly playing their game.
The golf analogy highlights the exact danger of this new environment. Equal access does not generate equal outcomes when the equipment is completely asymmetrical. And this asymmetry creates a very dangerous illusion regarding price discovery.
Meaning the idea that the price of a stock at any given moment reflects all known information about that company.
Yes, the night market offers incredibly fast price discovery when a headline drops. But fast does not equate to accurate.
Okay, walk us through how a late-night headline actually gets digested in a thin market versus a highly liquid one.
Sure. Let's say a major tech company issues a confusing, maybe slightly concerning regulatory filing at 1 a.m.
Okay.
In a highly illiquid night market, retail algorithms and anxious night owl investors might interpret it as catastrophic, so they start dumping shares. And because the major institutional buyers, the mutual funds and pension funds who usually stabilize the market because they are offline, there's no one there to absorb that selling pressure.
Right.
So the stock price plummets 15%. It looks like a legitimate crash.
So the everyday retail investor sees those red blinking numbers, they completely freak out, and they sell their position at a massive loss, assuming the sky's falling.
Exactly. But then 9:30 a.m. arrives. The traditional regular trading session opens, and the quote-unquote smart money floods into the market. Their analysts have just spent the last 8 hours dissecting that 1 a.m. regulatory filing and realized the market completely overreacted. The news was actually just a minor bureaucratic hurdle.
Oh, wow. So they see the 15% drop, not as a crash, but as a massive discount.
Spot on. Institutional capital just sweeps into the order books, buying up millions of shares, and the price rapidly reverses right back to where it was the previous day.
Wow. So the everyday investor who panic sold at 3 a.m. basically locked in a 15% loss, and the big institutions simply scooped up their shares at a steep discount.
Exactly. Market data consistently shows that the regular market open at 9:30 a.m. and the closing cross at 4 p.m. will remain the true gravitational centers for accurate asset pricing. The pricing action during the 3 a.m. session is often just highly volatile noise.
Okay, so if the night market is structurally rigged against the retail trader with these wide spreads, thin liquidity, and massive information asymmetry, it really begs the question of why an everyday investor should even interact with it at all. Like, how do we navigate this endless cycle?
It introduces a really fascinating evolution in behavioral finance, honestly.
Mm.
As we transition to a continuous market, the most critical skill an investor can develop is no longer the ability to analyze data quickly. It is the psychological discipline to aggressively ignore the noise.
But the market platforms themselves are not designed to help you ignore the noise, though. I mean, the brokerage apps on our phones are heavily gamified. They utilize the exact same variable reward structures as slot machines.
Oh, 100%.
They rely on push notifications, flashing colors, and constant alerts just to capture our attention.
And that design creates a very specific psychological trap. Historically, the closing bell provided a forced cognitive buffer. If terrible news broke at 6 p.m. on a Tuesday, you physically could not panic sell your portfolio.
You had to sweat it out.
Right. You were forced to sleep on it, read varied analysis the next morning, let that initial adrenaline spike subside, and ultimately make a rational decision.
But a 235 market entirely removes that cognitive buffer. It turns your smartphone into a direct liability. If you wake up at 2 a.m. to get a glass of water, casually check your screen, and see your portfolio is down 5% in the night session, the friction that used to protect you is just gone.
It's totally gone.
You can execute a trade from your bed, half asleep, driven purely by the fear of missing out or the fear of losing more.
Which is mathematically the worst possible state of mind for capital allocation. The defense against this is anchoring your strategy in the fundamental economic reality of the assets you hold. The intrinsic value of a globally dominant corporation does not just evaporate in the middle of the night because an illiquid market is reacting to a rumor.
Right. Consider a massive entity like Microsoft. Their intrinsic value is built on multi-year enterprise cloud contracts, global software dominance, and deep AI integration.
Yes.
If their stock price drops 8% at 3 a.m. on a really low volume, did thousands of Fortune 500 companies suddenly cancel their Azure cloud subscriptions in the middle of the night?
Exactly. Or consider Visa. Does the volume of global credit card swipes and transaction fees suddenly halt because a few traders in a night session got spooked by an overseas headline? No. The underlying economic engine generating cash flow for these companies is exactly the same at 2 a.m. as it is at 2 p.m.
The company hasn't changed. The only thing that changed is the highly erratic price quote flashing on your screen.
And by reacting to that erratic quote, you are abandoning a long-term investment thesis to play a short-term trading game where the rules, the liquidity, and the spreads are all stacked heavily against you.
It really is the ultimate test of discipline. You have to recognize the profound difference between technological accessibility and strategic advantage. Yes, the 23-hour market is an incredible engineering achievement. It creates a frictionless global financial hub. But for you, the everyday investor, just because the casino doors never close, doesn't mean you are obligated to sit at the table and play against the house in the dark.
Very well said.
You have to rely on the deep liquidity of the regular trading day, stick to your long-term thesis, and recognize the night market for what it mostly is, a trap for the impatient.
You know, if we pull back and look at the broader implications of a market that never sleeps, it actually raises a deeply provocative question about corporate governance that goes way beyond just retail trading behavior.
Oh, interesting. How does 235 trading change the way actual companies operate?
Well, for decades, corporate communication has been built around the market clock. If a company has a disastrous earnings report or is facing a major scandal, the standard playbook is the Friday afternoon news dump.
Oh, right. You release the terrible news right after the 4 p.m. Friday closing bell.
Exactly. The goal is to give the market a full 48 hours over the weekend to digest the shock, read the context, and kind of cool off before they can actually sell the stock on Monday morning.
Wow, but if the Nasdaq is operating 23 hours a day, 5 days a week, that cooling off period is severely compressed.
It fundamentally rewrites corporate strategy. I mean, will we start seeing CEOs attempting to bury catastrophic financial disclosures by releasing them at 3 a.m. on a Sunday night, just hoping that human analysts are asleep and only the automated algorithms catch the headline?
That is a wild thought.
Right. Or will the continuous market force companies to be vastly more transparent, knowing that capital can flee their stock at literally any hour of the day or night? The 235 market won't just test the discipline of the investor. It is going to turn analyzing corporate behavior into a 24-hour endurance sport.
That is a staggering implication. The strategy of corporate damage control has to be completely rewritten for a world where the ticker never stops moving. It really highlights how this plumbing overhaul will alter the DNA of the entire financial ecosystem.
Well, that's all the time we have for today. Don't forget to subscribe and hit that like button.